Somewhere in a vault beneath the streets of London, the shelves are getting lighter. Not because anyone is stealing, because the world is buying. Silver, the metal most people forgot about for 45 years, just did something it has never done in the history of modern markets. It broke $100 an ounce, and then, within days, it crashed by 50%. Then it bounced right back toward 80. If that kind of violence does not wake you up, nothing will. But the real question nobody seems to be asking is not whether precious metals are going higher. The question is which metal deserves your attention right now. Gold, sitting above $5,000 for the first time ever, or silver, the volatile younger sibling that has already tripled in 12 months and might not be finished. Today, we are going to take this apart piece by piece. No hype, no cheerleading, just the data, the history, and the uncomfortable math that the mainstream financial press keeps dancing around. Let us start with where we are standing this very moment. As of early February 2026, gold is trading around $5,030 per troy ounce. Silver closed near $80. 12 months ago, gold was roughly $2,800. Silver was about $31. If you do the arithmetic, gold delivered approximately 67% for the full year of 2025. Silver returned 147%. Read that again. Silver more than doubled gold's annual performance. And even in the first few weeks of this year, silver is up over 13%, while gold has gained about 5%. The white metal is running faster, and it is not even breathing hard yet. But raw performance numbers tell only half the story. The more revealing figure is what professionals call the gold-to-silver ratio. At its most extreme in mid-2025, that ratio touched 100 to 1. 1 ounce of gold would buy you 100 ounces of silver. Historically, that kind of spread is an alarm bell. The long-term average over the last century hovers between 47 and 80. When the ratio spikes above 90, silver has, without exception, staged a violent catch-up rally in the months that followed. By late 2025, the ratio had compressed to roughly 57. Right now, it sits near 64 after the recent volatility. Bank of America's head of metals research, Michael Widmer, built his extraordinary price model on precisely this dynamic. His argument is straightforward. If gold reaches $6,000 per ounce and the ratio compresses toward historical norms of 20 to 45, then silver lands somewhere between $135 and $309 per ounce. That is not a fringe blog prediction. That is Bank of America's published research, and it was reiterated in January of this year. Now, why would gold go to $6,000? Because Wall Street's biggest names are lining up behind that target with unusual conviction. JPMorgan raised its year-end 2026 gold forecast to $6,300 per ounce on February 2nd. Deutsche Bank reiterated its $6,000 target the same day. Wells Fargo bumped its year-end range to $6,100 through $6,300. Societe Generale is at $6,000. UBS says $6,200. Goldman Sachs, typically one of the more cautious voices, lifted its forecast to $5,400. Even Macquarie, one of the lower estimates, raised its average 2026 projection to $4,323. When this many institutions cluster around the same neighborhood, the signal is difficult to ignore. The engine underneath this consensus has a name that most retail investors still do not appreciate: central bank accumulation. The People's Bank of China just extended its gold buying streak to 15 consecutive months. In January alone, Beijing added 40,000 troy ounces. China's total gold reserves now stand at 74.19 million ounces, and the dollar value of that hoard jumped from $319 billion to nearly $370 billion in a single month. But China is not alone. The World Gold Council reported that central banks collectively purchased 863 tons in 2025. That is down from the record pace of 1,092 tons the year before, but it remains enormously elevated by any historical standard. Consensus estimates suggest central banks will continue buying at roughly 800 tons through 2026. These are not speculative hedge funds chasing momentum. These are sovereign institutions making multi-decade allocation decisions. They are telling you in the most expensive language possible that they expect fiat currencies to lose purchasing power. And this is where the story takes a darker turn. The United States federal debt has surpassed $38 trillion. Global sectoral debt reached $340 trillion by mid-2025, according to State Street Global Advisors. The dollar index fell roughly 10% against major currencies during 2025. What the financial world now calls the debasement trade is no longer a fringe thesis. Paul Krugman, a Nobel laureate who spent most of his career skeptical of gold, recently acknowledged that the shift away from U.S. financial assets by both foreign and domestic investors is real and measurable. When even the skeptics start conceding the point, the trade is no longer early. It may, however, still have a very long way to run. So gold has the establishment behind it. Central banks, Wall Street forecasts, sovereign debt dynamics, and a weakening dollar all point in the same direction. A 20 to 40% move from current levels to 6,000 or above seems, by the standards of this market, almost conservative. But here is where things get genuinely interesting. Because if gold is the aircraft carrier, silver is the fighter jet strapped to its deck. It moves faster, hits harder, and can change direction in ways that terrify anyone who is not strapped in. On January 23, 2026, silver smashed through $100 an ounce for the first time in recorded history. Forbes, Reuters, and MarketWatch all covered the milestone in real time. The move was fueled by a combination of retail investor momentum, institutional positioning, and a physical market that has been structurally short of metal for 6 consecutive years. Within a week, silver rocketed to $121.67, an all-time high that left even the most hardened bulls stunned. And then, on January 30th, the floor fell out. Silver crashed 31% in a single session. The CME raised margin requirements. The Federal Reserve signaled tighter policy ahead. The dollar strengthened. Institutional sellers, led by the very banks that had been accumulating short positions for months, unwound their exposure in what traders have already started calling the February massacre. By February 5th, silver had plunged to $63, a full 50% below its peak. Read that sequence again. 122 to 63 in 8 days. That kind of move destroys portfolios. It also creates the buying opportunities that define generational wealth, because within days, silver reversed and clawed back to $81.50. The structural forces that drove the rally did not disappear with the correction. The vaults are still emptying, the deficits are still deepening, and the industrial demand story is only accelerating. Let us talk about that demand story, because this is where silver separates itself from gold in a way that most investors completely misunderstand. Gold is a monetary metal. Its value is almost entirely derived from its role as a store of wealth and a hedge against currency debasement. It has very limited industrial application. Silver is both. It is a monetary metal and a critical industrial input, and the industrial side of the equation is entering a phase that has no precedent. The Silver Institute released its latest report on February 10, 2026. The numbers are sobering. The global silver market faces its 6th consecutive year of structural deficit. Total supply is projected at roughly 1,050 million ounces in 2026, a decade high, yet demand continues to outstrip that figure. Industrial fabrication, while expected to dip 2% to around 650 million ounces this year, remains near record levels. Physical investment demand from retail buyers of coins and bars is seen surging, offsetting any softness in industrial offtake. But the real catalyst is what happens next. Solar photovoltaic installations consumed a staggering amount of silver in 2025. Each solar panel contains roughly 0.64 ounces of the metal, and global installations are growing at a pace that is devouring supply. Industry analysts project that by 2027, solar applications alone could account for 750 to 800 million ounces of annual demand. That single sector could consume more silver than the world currently mines in an entire year. Electric vehicles require significantly more silver than traditional combustion engines, with the metal used in battery management systems, power electronics, charging infrastructure, and electrical contacts. The Silver Institute forecasts that automotive silver demand will grow at a compound annual rate of 3.4% through 2031. Then add data centers, artificial intelligence infrastructure, semiconductors, the 5th-generation wireless buildout. Every major technological trend of the next decade runs on silver. This is the asymmetry that Bank of America's Widmer is pointing to. Gold gives you protection. Silver gives you protection and a leveraged bet on the industrial future of the planet. When gold rises 20%, silver has historically risen 40 to 70%. When the ratio compresses, the multiplier effect is even more dramatic. Now let me be absolutely clear about the risks, because anyone who paints silver as a one-way ticket to wealth is either dishonest or ignorant. JPMorgan has warned that silver could crash back to $50 or $60 if the speculative froth blows off. The World Bank's 2026 forecast sits at a modest $41 per ounce. Macquarie is also on the conservative end. Silver's volatility is not a theoretical concept. We just watched it lose 50% of its value in 8 days. The CME can raise margin requirements overnight, triggering cascading liquidations. A hawkish Federal Reserve can strengthen the dollar and make silver more expensive for international buyers. And the very banks that publish bullish research also hold massive short positions on the COMEX. The January 30th crash coincided with JPMorgan closing over 600 short contracts, according to COMEX data reviewed by traders on social media. The game is rigged in ways that retail participants often learn about only after the damage is done. So what is the intelligent play? Let me walk through the math as dispassionately as I can. Gold at $5,000 with a consensus year-end target of $6,000 to $6,300 represents a potential gain of 20 to 26%. That is solid. That is reliable. That is what institutional portfolios are being built around right now. Silver at $80 with a base case from many analysts between $100 and $150 represents a potential gain of 25 to 87%. The extreme scenario from Bank of America, $309, represents a gain of 286%. Even the midpoint of 135 would be a 69% move. In early 2026 alone, silver already demonstrated that it can gain 13% while gold manages 5%. But the number that haunts me is this one. Silver's 1980 peak, the legendary Hunt Brothers spike, reached $49.45. Adjusted for inflation, that nominal figure translates to roughly $185 to $190 in today's money. Silver already briefly exceeded $121, but in real terms, it has not yet matched a level set 46 years ago. Gold, by contrast, is trading at multiples of its inflation-adjusted 1980 high. Silver has not even caught up. If it merely revisited its inflation-adjusted historic peak, that would be approximately $190. If the current cycle, driven by genuine supply deficits and irreversible industrial demand rather than two brothers trying to corner a market, pushes beyond that level, then Bank of America's $300 target looks less like fantasy and more like extrapolation. The timing question is the hardest one. After the February massacre, silver is sitting at $80, well below the $100 milestone it breached just 3 weeks ago. Some analysts see this pullback as a gift. Kitco reported on February 10th that structural deficits keep the bullish outlook intact despite the volatility. Others warn that the path back to triple digits could take months, not weeks, and that another violent shakeout is possible at any time. The honest answer is that nobody knows the timing. What we can observe is the direction of the structural forces. Supply is constrained, demand is accelerating, central banks are hoarding gold, governments are debasing currencies. The ratio between the two metals remains historically elevated, which favors silver's outperformance on the next leg up. There is one more thread worth pulling. The relationship between gold and silver tends to follow a specific pattern during precious metals bull markets. Gold leads first. It establishes the narrative, attracts institutional capital, and sets new highs. Then silver follows, often explosively, in what veterans call the catch-up phase. We saw this in 2010 and 2011, when gold moved from $1,200 to $1,900 while silver rocketed from $18 to nearly $50, a gain of almost 177%. We saw it again in 2020, when the post-pandemic recovery sent silver from $12 to nearly $30 in just 5 months. The current cycle appears to be following the same script, but at a larger scale. Gold broke through $4,000 in October of 2025 and has since pushed past $5,000. Silver followed with a delayed but far more violent move, tripling from $30 to $121 before correcting. If the pattern holds, the next phase belongs to silver. What the smartest money is doing right now, based on publicly available data, is accumulating both metals but tilting heavier towards silver on pullbacks. The gold allocation provides the anchor, the insurance policy, the thing that protects your portfolio when everything else is falling apart. The silver allocation provides the leverage, the upside optionality, the trade that can turn a modest position into something life-changing if the supply squeeze intensifies and the ratio continues to compress. You do not need to choose one or the other. You need to understand what each metal does within a portfolio and size your position according to your ability to withstand volatility. Because make no mistake, silver will hurt you on the way up. It will shake you out. It will drop 20% in a Tuesday afternoon and make you question every financial decision you have ever made. And then, if history and the current data are any guide, it will turn around and make the people who held on look like geniuses. The question is not whether you can handle the upside. Everybody can handle the upside. The question is whether you can handle the drawdowns that come before it. We are living through something that does not happen often. Gold above 5,000. Silver in a structural deficit for 6 straight years. Central banks buying at a pace not seen in decades. The dollar losing ground against virtually every alternative store of value. Wall Street's biggest names calling for $6,000 gold. And one of the world's largest banks publishing a model that puts silver at $309. Whether these projections prove accurate or wildly optimistic, the direction of travel is unmistakable. The metals are moving. The only real variable is how far. I do not advise anyone to invest in or purchase anything. I present data that may help you understand what is happening in the world around you. If you found this video useful, subscribe to the channel, and I will see you in the next one.